Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here with the Private Lenders Podcast, as always sponsored by hardmoneymastermind.com, our community of private and hard money lenders. Go create a free account anytime at hardmoneymastermind.com. Okay, today we have a special guest. We have Warren from ICG10 Capital, Miami, Florida. Warren, thanks for being with us.
Thank you for having me.
Yeah, no, we appreciate you taking the time. We know you keep quite a busy schedule. I see your stuff on social, your posts and everything else. I know we have a couple mutual friends from business. And we're gonna back up here in a second, but I'm sure that people are gonna be interested in hearing about how you've grown your operation in not a ton of years to pretty high volume, like 250 million a year in production, somewhere around there.
Somewhere around there, yeah. I mean,
Awesome.
This year might be less. I think last year was a little bit extraordinary, and the year before.
Yeah.
With COVID, I think the volume went up tremendously.
You know, it's wild how that all played out during those few years of a pandemic. You know, a lot of good stuff, some bad. But if you wouldn't mind, could you back up a little bit and let everyone know how you got involved in private lending in the first place?
Sure. So when I was young, I was applying for private equity firms, and I eventually landed an analyst position at a private equity firm. And we were buying non-performing loans. So when these things go bad, and we were buying them in bulk. So we bought about 8,000 of them from big banks directly. And from there, I was an analyst, and I moved up to executive director there at the private equity firm. And I decided I wanted to leave and do my own thing. So in the beginning, I was starting to raise funds, and then and that was nice for the fix and flip stuff, but for the long-term rental stuff, I really couldn't finance it at all. Mainly because at the time they were like 4% rates, so there was no way I could raise money from private investors at 4% for 30 years, and so we started funding them and selling them essentially like a lot of other lenders do, just packaging them and selling them a few at a time, and that turned out well. So we went from not doing that many loans, I would say probably maybe 50 a year, to 500 a year we did last year.
And when was that you started? What was your first year of ICG10?
So it's a little bit complicated because I had started the company while I was still in the private equity firm.
Yeah,
at the time.
Side hustle. I get it.
It was a side hustle, so I don't really consider it, like fully started until like 2016. And then I devoted my time fully to that.
So the original setup, and I'm guessing it might still be like this, is you have private capital that you've raised either in a fund or direct placement or whatever for the short-term stuff, and then the longer-term stuff, institutional capital, because if individual investors don't want to keep their money out for.
Yeah, and then there's some loans like that don't fit our box necessarily, even on the fix and flip stuff that we'll sell. There's stuff that doesn't make sense to keep on our books. It's too big balance, for instance, or something like that,
right?
Where the risk is too high or the leverage is maybe too high, and we can recycle the capital and it makes more sense. So it kind of depends loan by loan, really.
Cool. And did you start more local focused to South Florida or Miami in particular, or did you have a big geography from the get-go?
Yeah, so we started kind of in a few different markets to start with, to kind of get comfortable. At my previous firm, we were buying loans nationally, so I was still pretty comfortable nationally. But we also obviously didn't want a lot of defaults when we were underwriting the loans. And so we kind of started with a few markets that we thought were growing at the time, was like Tampa, like the secondary kind of markets where you a lot of flips, and more volume based. I would say like in the 100 to 200K loan amounts, but 50 of them at a time from the same borrower. And so we were kind of doing that. And then as we grew, we started just basically accepting everything from everywhere. I mean, obviously there's areas that don't make sense. We don't touch anything rural. We don't touch anything. I mean, like Detroit, we don't technically say no, but I've not funded one deal in Detroit,
Sure.
you know, because it doesn't meet our criteria. So, you know, everything there is like 50K a door, and
Yeah. No doubt.
that's not going to make sense for us. Because I know that when these things do go bad, the fixed costs, you know, the lawyer fees, everything like that, that's not a percentage. That's a fixed cost, and you know, just to start a file, 2K, you know, the taxes, all that stuff, you won't be underwater very fast on small loans.
No, property taxes can vary a lot too, based on jurisdiction, like a ton. So no, we have plenty of experience with that whole thing. What was your team like in the beginning? The first couple of years, like who were some of your first hires, for example?
Yeah, so the first you have to get, at least for me, was processing and underwriting, the biggest thing. The legal we outsourced to start, and we still do to some degree. Servicing also outsourced. That doesn't make sense to keep inside. I mean, obviously, if you can grow big, then you can have your own servicing arm. But for me, it didn't really make sense. And you can, even if you do end up selling a loan on the 30-year stuff, you can still sell it servicing retained, but master service it and have a real servicer, you know, underneath. So the processing, the underwriting are the biggest things, and then everything else you can really outsource. Even the loan originators I wouldn't consider them technically hires, because they're more like 1099, like kind of agents.
Salespeople.
Sure.
Exactly. So like realtors, I would say is the equivalent.
No, that's interesting that you started. I know that a lot of people do move to outsource servicing, but typically the story is that people started in-house until they decide that they don't want to run it themselves, or maybe just a capital structure is such that they have to have a third-party servicer.
Right. So you have like FCI or something like that kind of helps you do it kind of easily. In my background, we were buying. So for instance, one of our first portfolios we bought from SunTrust, and it was 50 servicers. Like all of them, like every single loan was coming from a different servicer. And so we hated it pretty much. I've had experiences with pretty much every servicer you can possibly imagine, even ones that went out of business while we had the loans. And so that was a nightmare.
No, I can't imagine that kind of mess.
Oh yeah, we had like iServe, for instance. We bought a pool. Those were not like first position loans, so I don't consider that one of our. But it was kind of like a mix mash of seconds and things like that. And we had iServe that was managing them, and they went out of business during that time, and we had some collections that were coming due. We couldn't even collect on anything. It was crazy.
Was that when the market was way down, like 2010 and 12 and all that stuff, and people are selling off their NPLs?
Exactly. So at that time, we started in 2009 buying non-performing loans.
That makes sense.
When I started my own firm was 2016 full time. So at that time, the non-performing loan stuff was pretty overhyped. You know, you had like Starwood and BlackRock were buying them directly, and it didn't make sense. That's why we started lending our own money. Yeah,
no, that does make sense. Over the years, what is your lead gen and like main marketing channels been? Because I mean, obviously, you need a ton of leads to do that kind of volume. Yeah, we're all in a high lead game. Like for example, between our couple offices, we probably do 2,000-3,000 leads a month, and that's to close like 20 deals. You know,
because the closing traction. Yeah, it also depends on like your terms and how competitive it is with like the national lenders and things like that. Sure. But yeah, you absolutely can go through 100 deals and close one, right? So that's just the business. But as far as the loan generation is concerned, so we try to do mainly like organic things. You know, even going to trade shows and conferences, I don't usually do that anymore. Because a lot of the target market there is other lenders and AMCs and other vendors, and it's like I'm not going to get a client there. So we don't usually do that unless it's like the REIA kind of stuff, local stuff. But really, the way I structured my business is I try to outsource the lead generation. So most of like probably 80% of the deals that we do come from mortgage brokers. And
80%.
And they send volume. Yeah, exactly like that. So because lead generation is pretty hard, so I try to leave it up to them. And obviously we do a low margin there, but it's on a volume basis, so it makes sense.
Yeah, exactly. What do you think? So like inside your business, like what are the highest level activities? Obviously that can be done kind of on a daily basis, because everyone's, the beauty of hard money lending and private money lending is there's no right or wrong way to do it. As long as you're not losing money, then that's wrong. But besides that, we know lots of different lenders across the gamut. Some of them are high net worth individuals that just want to responsibly deploy their own capital, and they're trying to just do everything simple, one-man operation. Other folks don't want to put any of their own capital in, and they just want to raise everything. And there's everywhere in between. We do about $50 million a year in production, and that's kind of our sweet spot. It's low overhead, heavy margin. That's what works. We try to be self-cap, put up as much of our personal capital as possible on some of these things. So like inside our business, our high level things, obviously besides some marketing stuff, is, for us, like for me, it's underwriting, make sure every asset that we lend on is sufficient. Chris is more kind of investor relations, CFO type of stuff. Like inside your operation, like what are some of the higher level activities?
Yeah, for sure, investor relations is number one. If you don't have capital, then you can't lend. And then obviously the lead generation is, I would say, a big component of that. But equally important is the underwriting, because you obviously don't want these loans to go bad. And even if you do end up, because obviously there's different ways to skin the cat, but even if you do end up selling the loan and it defaults and you have enough of those, then you're going to burn that bridge with that investor or that hedge fund or whoever you're selling the loan to. And so that's equally as important as the marketing. It's kind of, you don't want to be doing garbage deals. They have to be paying, and that's a function of your underwriting. So,
yeah, speaking of underwriting, I was curious. One thing I jotted down before is, since you lend in many states around the U.S., how are you doing third-party due diligence? Like, say you do a loan in Chicago, how do you guys value those properties?
So we do an appraisal on every single loan.
Okay.
Yeah, and then we have our in-house review that appraisal. It's like an in-house appraiser reviewing the appraisal.
Okay, so you can pick your own third-party appraisers in whatever market it might be.
Yeah, so we use an AMC. So we usually use the service called Connections, and they outsource the different AMCs. You can have Appraisal Nation, Fast App, and Center, and there's a couple others, but those are usually the main three that come out of that. And so we have a full appraisal on them, but obviously, appraisals can be wrong.
Appraisals can be wrong.
Yeah,
that is a fact.
Yeah, so that it's important to review, to look at the area. Obviously, you don't want a street where they're all run down houses, in Chicago, where it's a bad market, and then go try and sell it, right? Sure. Once the flip is done. So it's also a qualitative thing. It's not just quantitative. But that's due diligence that we try to do up front before we get the appraisal, to see if it's a market that if it's a street that we want, if we're comfortable with the track record. If it's a risky street, then we're not going to do a first-time borrower. But if it's like a risky street and the guy has done 50 flips in that area and the market, and he knows exactly how to get out, then that's a different story. So it depends on the track record as well. And credit plays less of a factor for us on the fix and flip stuff. But obviously we don't want to see a ton of delinquencies. Like okay, so you're going to take out a loan from us and not pay us back.
Right. No, you can see if they're not paying their other bills, they're probably not going to pay you either.
Yeah, exactly. So, but if he's got like one medical collection,
it tells a story. It tells a story. And I think early on in our career, I don't think we realized, and Chris and I both kind of came from the banking and credit backgrounds, but I still don't think we realized that this is just not an asset-backed loan. Like the collateral in the asset is the backstop, but the characteristics of the borrower and the capacity of the borrower and the credit of the borrower is really going to determine if these things are going to execute or not. Because listen, you can do some low ass LTV loans all day long, but it is just going to be a nightmare and a headache down the road.
Yeah, yeah, exactly. And for us, we are pretty aggressive on the LTVs, on the fix and flip, which is why the due diligence needs to be strong and the track record should be strong. The higher the LTV is. But what I noticed, before I started my own firm, I had started a fund at the private equity firm that I was at. I was executive director, so I started a fund within the company, and it was just straight regular hard money. It wasn't like fix and flip or all this stuff, right? It was just like 60-70% LTVs, 12 and 2, right? And very limited questions asked because the market was still pretty hot at that time. But completely different than what we're doing now, to go up to 90% of the purchase or something like that, right? It's a completely different loan. And those were more of a headache, to be honest with you. The 60-70% LTV stuff, those are troubled borrowers, and more often than not, like, you're going to have problems. But I mean, we were underwriting it like a non-performing loan. So are we comfortable taking over the property if the guy doesn't pay? So it's a different underwriting.
Yeah, and it's fine to have some of those. We all do, but you can't have it be too much of the portfolio.
Yeah, exactly.
You have nothing but back office headaches all the time, and
especially on the refi stuff, because the refi is the stuff that defaults. The purchases usually don't default nearly as much, but the refi cash out stuff.
Yeah, because they have no exit strategy. Like the purchases are easy, because they're buying it with the purpose of reselling it, fixing it up and selling it. I agree with you. Any refinance in general has more headaches that have to.
Yeah, we're much more conservative on the refi bridge stuff, not on the long term stuff because obviously we have a takeout on that. But the refi bridge stuff, more often than not, defaults, and so our LTVs are much less aggressive than it is on a purchase. That's just
where do you think the financial markets are going to go in this space? And I mean, nobody fully knows. And I think people would have thought things would have changed differently than they had over the last few years, because the market's been so weird. But I know, and internally as well, like, we do a lot less fix and flips.
Yes.
There's just a lot less. There's just hard to find deals that work, right? In general, and even though Peer Streets and some other capital sources aren't necessarily around, or it's more challenging to get deals through, just with the rates being significantly higher and the market not continuing to appreciate, the fix and flip stuff's gone. Like, I'm curious, like, if you think capital markets is always going to be available for fix and flips, or if it's just going to be rental 30 and longer term paper, because I think the rental 30 product's amazing, and we got in this space in 07, and we were kind of doing stuff 03, 04, 05, 06 before that, and they didn't have that. They didn't have that type of product back then. And Chris and I were always like, there's a demand for this, even if it's 8%, 30-year fixed, whatever. There's a huge demand for it. So I would guess personally that will continue.
Yeah, I think that it will continue. I also think the fix and flip stuff will continue, not at the rates that it was at, because it was kind of crazy, and also we had lower rates back then. Now you can earn 5% in your savings account, so doesn't make sense to lend it out at 7. So and that was the whole Peer Street model, was that at that time. I mean, between you and I, it's public knowledge, but I was sued by them, and we settled on a repurchase. But
for like a buyback or something.
Yeah, exactly. It was like a $5 million multifamily thing. So. But yeah, I mean, they're nice guys. It's just we have a disagreement, and this is what it is.
Yeah, I mean, buybacks that's one thing that we saw. So backing up a little bit, because I know you don't know our whole history, but when we were in banking and mortgage industry, we were doing real estate investing on our own. But like, our main job prior to HMB, prior to this lending company, was in banking and residential mortgage and some commercial bank stuff too. And around the time of the crash, we saw a lot of what happened specifically with buybacks.
Yeah.
And granted, that was a different niche. It's a different market. That's subprime stuff, everything else. But the people who ended up holding the paper sue you to buy it back.
Yeah.
And that just put companies out of business left and right.
Yeah.
And so some of the people in our mastermind group, in the Hard Money Mastermind, they ask us questions like that too. And we don't have experience with the institutional stuff directly, right, but we do from like all of our friends in the industry. And they're like, what happens if you get hit with a buyback? And we're like, it depends.
Yeah,
Like,
I mean,
not
sometimes you
totally
don't have
sure.
the capital to buy it back, right? Like that's why you sold it. So
You don't have the capital to buy it back, or sometimes it's not a situation where you should be forced to buy it back.
right.
A lot of those agreements are written for nothing but fraud, unless you gave us bad information.
Right.
But
Yeah, I
that
mean, some
doesn't
of the
mean they can't
buybacks are
try.
like if the borrower doesn't make any of the first 3 payments, usually something of that sort. But yeah, I mean, buybacks are going to go on the rise if delinquencies go on the rise. But the thing is, like, and we saw this in the non-performing loan space also when things did hit the fan, is when things go bad, nobody has money. So you can sue everybody, but
Right.
you're not going to get money back usually. So it's
All right.
usually a waste of your money. And on the non-performing loan side, for instance, we had personal guarantees and we never enforced any of them because we knew that all the borrowers had no money, right?
Right. And then you're just spending legal fees for no reason.
Exactly.
It's the same thing if you have a bad default right now, like, and we have personal guarantees with our borrowers. Do we want to even fight to collect a few $1,000s? It's not even worth
sometimes,
it.
and you don't know. I mean, you can sue everybody, and it's
Yeah.
the U.S., so you can sue everybody. But are you going to get money back? Is the question.
This is
doubt.
true. Yes, we started talking about what we see in the future a little bit. I'm curious to hear your opinion on, in the past 12 months, what have been a couple of the major changes that you've seen in our niche of lending?
I mean, you hit on it for sure. We see a lot less flips than
Right.
we used to see. I think because the flippers are a little bit scared. Some of them are left holding the bag when property values went down, especially on the luxury stuff. I've seen a lot of luxury stuff go down or stay on the market for an extended period of time, which clearly hurts the flipper profits. I think the 30-year stuff is here to stay because the rents have gone up along with all the expenses. So the cash flows still kind of work. And there's not a lot of other opportunities because the non-DSCR stuff is going to get hit with delinquencies like crazy. So, and then the multifamily stuff I think that's going to be the first stuff to fall. The multifamily, the industrial, all the commercial stuff. It's especially as companies go out of business, like there's going to be even less demand for that, and it's very hard to finance it. And there's not 30-year loans like it is on residential. It's usually like 5-year balloons. And what are you going to do when you're trying to refinance it? And instead of the 75, they're giving you 65%.
Yeah.
Right?
Yeah, I mean, no doubt on the commercial side. We haven't really thought too much through the multifamily side, just mostly because we don't do a ton of multifamily.
Yeah.
You know, the stuff in our areas that's multifamily is humongous stuff. Typically bigger than we want to get our hands on, or it's crappy stuff in Baltimore or something like that we don't want to mess with. We are very active on the commercial side, and I don't know. I feel like the way we look at it in the back of our head is, we want to write a loan to a good operator, but we also want to write it at a loan amount that if we had to take it back, we'd be comfortable with that, knowing that we're not 100% sure what the exit strategy is because there's no clear exit. I mean, like we've done deals like on professional office buildings where like the numbers are crazy where, hey, I'm buying it for 1.5, they'll put down 750, we'll fund 750, and they got 780 credit and they still can't get their bank to do it, and it's almost all occupied type of thing. And it still services the debt.
Right.
So we kind of go into it with a plan of, hey, they think, oh, I just need a short-term loan. It has to close too quick. My bank's taking longer. We come in, obviously it's significantly higher in terms, and some of them pay off. Some of them just extend and pay us 3 points to extend it every year, and they keep it on their books and see what happens. So I don't know. We've kind of gone into it as like, hey, if we got to own this asset at this price, at this discount, we're comfortable with it. But it's not like we would lend an idiot that we knew that would happen to. It's a good, solid borrower that is kind of hedging that they think they're going to be able to refi. But the commercial markets, I mean, they're not completely shot, but like, dude, the rates are high and it's not easy to get.
No, it's tough. And like, even I'm getting emails because I own my house. Like I have a huge ton of equity, like millions in my house of equity, and I always get these offers in the mail, these letters of like HELOCs, and they're like at 8-9%. I'm like, who is taking this?
What am I going to do with that?
Yeah, exactly. Yeah, that's the market. And back in the day, a lot of it's interesting because we had a group of capital investors that used to invest with us into some deals, and their play was, I'm going to buy. They also own a lot of real estate, so they buy all their real estate in cash and they lever it with HELOCs or lines of credit with the bank, and then they would just deploy it and play the arbitrage game. And like that game for them is over too, because they were getting capital at 4% and then letting it out at whatever.
I mean, there was a time where our DSCR loans were in the threes.
I remember that.
I did a 3.2% portfolio loan.
I remember.
That's insane.
I remember it.
No income, like 3.2.
Yeah.
But I was saying it was insane at that time, but it's that was the market. That was the free money time.
Yeah. What do you think, while we're kind of on this topic real quick, before we let you go, what do you think about kind of the residential markets in general? I mean, I'm guessing your areas are similar to our areas where, nobody's really selling because they're not going to get out of a 3% interest rate to get a 6% interest rate or maybe even higher. And there's just a lack of supply in a lot of this. And, any house that comes on the market is just going to get sold at any price it comes on. And it's not going to be like overinflated and ridiculous, but anything that's fairly priced will sell. And if you're a buyer, it's challenging to buy properties, homeowners and investors. So like, I'm curious what your thoughts are on just the residential sector.
Yeah. So I think there's a bifurcation on the residential sector, because I think the luxury market's getting hit pretty hard. Whereas the low and mid-tier markets are actually booming because there's not that many transactions and there's not that many. So I mean, for sure, like loan officers or realtors or title companies are suffering right now because there's a lot less transactions than there was last year.
Very much.
That's because there's both the supply and there's the demand destruction that's happening because of the Fed and because people are locked in at 3% rates. And there's no reason for me, if I have a $5 million house, to move up to a $7 million house, because it doesn't make sense. My payments double, my interest rates double, and it's marginally better. And so it doesn't make, right? It makes no sense. So all the people that have the low rates are either going to try and rent it if they want to move up to something else, or just stay in the house, which is the more likely option. And so I think it kind of depends what kind of market you're talking about, because I see houses in my neighborhood which are in the luxury market, they're sitting on the market. And whereas before there was people just coming in blind, I don't even want to see the house. No appraisal, no contingencies, no inspection, no nothing, full cash offer, and then they're just going to refi it afterwards or whatever. That doesn't happen anymore. Now they're sitting on the market for 4, 5, 6 months. But on the lower end of the spectrum, there's also no options. And so the stuff that is on the market gets sold.
Mostly talking about the median housing price stuff. Which I think
the median housing price is going to go up. There's no alternative, because we're not building enough to go through the demand, and then the supply is actually getting killed because of the policies that are going on now. I think the only thing that might change it is like if you start doing like 40-year loans or something, where the rates are going to be lower, and that might incentivize purchases. I'm not saying it's the right thing to do. I think that's one of the things that might happen politically.
What do you see that's similar in the vacation markets? I mean, you have heavy vacation markets, in Southeast Florida.
So I have a lot of friends that do Airbnbs, and they're quite successful. And for a while, especially on the big lenders have been saying that the short-term rental market is going to get killed. And then once it does, all of these don't cash flow on a regular rent. And so then they're going to get hurt because they didn't underwrite them on regular rents. They just underwrite it assuming that the vacation rental rents are going to be there forever. And that's possible. And you've seen markets like that, especially like Phoenix and stuff like that. I'm here in South Florida, so I don't see as much of that because the demand is strong and there's still a lot of tourism. But I think for sure it'll cool down. I don't think it's to the extent that people think. I think it's getting a little bit blown out of proportion.
I think that the financing on short-term rentals has been a little wonky in the past couple of years. Like they were creating products specifically for that, and then kind of pulled it and then it trickled back. And obviously the financing is going to affect the ability to acquire those kinds of properties. Because not everyone's a cash buyer, right?
And most people are not.
So. Most people are not. Yeah. So the financing is going to affect it. But I think like the demand on both owning short-term rentals and using short-term rentals is going to grow.
Yeah.
I feel like.
Yeah, no, I think the same way. I think all of the stuff that's not luxury right now, actually right now might be a good time to buy luxury because it's getting hit. If you're in that market, but all the medium stuff is hard to buy right now, and we're seeing a ton of transactions. It's not going to be the same as last year because last year was just it wasn't even a healthy market. You can't just be competing with 30 other people trying to get your offer in and sell your firstborn baby to get the house, right? It doesn't make sense. So that's not sustainable, and it was not healthy for anybody, for sellers or buyers.
It really wasn't.
And you have these realtors that were just like, oh yeah, I'm a hotshot, and they weren't even putting like pictures of the houses. I was seeing it. It was like the pictures were all blurry and everything, and it would sell in 2 seconds. I was like, what?
Yeah, and the problem with, like you said, with them and title agents and mortgage brokers is they forgot about the core fundamentals of running a business and growing a business, and now they're stuck. Because before it was like, cool, we got deals, let's go. And then now they don't have deals, and they have no competitive advantage over anybody.
Yeah,
because they didn't.
Yeah, especially on our side where pricing was the main thing, right? So a lot of brokers were competing on price. But there's other things to compete on, right? There's speed of close, certainty of close. Right. There's customer service. There's other things than just price, right? Not everybody can be a Walmart of the mortgage business, and so the way you differentiate yourself kind of determines on how many clients you get. But a lot of the people that had it easy because the leads were just flowing in and trickling in are having a tough time right now. And I see it even with realtors. I see it now. Most realtors are not doing sales because there's less transactions right now. And because there's less transactions, they're trying to do rentals. And I mean, that's killing their income for sure.
Yeah, I mean, it also depends on, during an overly hot market like that, some people make mistakes in terms of how they scale their business as if it were going to be like this forever. Yes. Now, the right way to do it, to take advantage of a hot market, is to kind of control your overhead, stay in your lane, take advantage of the increased transaction volume and everything else. And this goes for, people across the board, lenders, real estate companies, title companies. Take advantage of that additional income that's happening right then, but don't think it's going to be that way forever. Exactly. Because now you're at a point where you have to have that kind of volume to run your operation. And if it's not there, you got to make major changes. And
then you're going to have the debt service to support it, because you can't just fire anybody in immediately before the numbers are retroactive. And you're like, oh shit, we lost this amount of money, Then you start firing people you don't know immediately, right? And so it's retroactive. And so that's what I've tried to do with my business, and I'm sure you guys do with yours, is to kind of have everything more on especially with the loan officers, though, it's like on a commission basis. And so like if things do go bad, you lower your risk as a business owner as well, because you don't want to get held, you don't want to hold the bag either. But I have seen it bad. And even on the borrower side, like my father during the crash, he lost many properties because he wasn't able to cash flow the debt at that time. And that's just poor management, and also thinking that just times always go up. And that's just not the case. You have to be a little bit risk adverse, because otherwise you end up losing everything at one point.
Yep. Exactly. And I think that's probably a good note to wrap up on, like for anyone watching, listening, or participating in the mastermind group. At all times in the market, you have to be responsible with how you run your business and grow in the right way. Never stop marketing. Keep that marketing going forever. That should be the last expense that you cut, right? Because you got to keep deals coming in the door, even when they're not so easy to get. So yeah, good stuff today. I appreciate you taking the time and coming on. Where can people find you if they want to reach out?
Sure. My website is ICG10.com for our mortgage company. And I'm pretty active on Instagram, Warren Ifergane, and that's my handle. So
awesome. No, thanks again. We appreciate you taking the time. We'll definitely get all this information over to you so you can share it with your people as well. And yeah, Absolutely. We should do it again sometime.
Thank you for having me.
Thanks, guys. See you next time. Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note, that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.